Well, here we are. Welcome to 2023, investors. My name's Seth Golden. This is the inaugural episode of State of the Market by Finom Group. I'm your host as usual. And indeed, 2023, we're turning the calendar year. 2022 was, I don't think I'm sugarcoating it when I say awful for most investors. That you're a bond investor, metals investor, typical equities investor, just technology, maybe just the Qs, maybe just Bitcoin, maybe crypto. I mean, it was bad all around. Energy. That's where you had to be in 2022 if you were going to outperform the benchmarks. I was not in energy. I don't plan on being in energy. I don't like the setup for energy as we do turn the calendar year here. Earnings are actually, if you look at all the different sectors in the S&P 500, the one that is expected to have the greatest earnings per share decline in 2023 is, lo and behold, energy. A reason for that, the main reason for it, is all of the share issuance, and so you have this just enormous amount of overhead supply in the energy sector share count or outstanding shares. It makes it very, very difficult to grow earnings. It has no reflection on what the price of crude is going to be or anything like that. It's just a matter of supply versus demand. And trying to jump over that high bar that the energy sector set in 2022 is indeed going to be a daunting task. So no plans here to venture into the energy space. I'm not saying energy will be down. I'm just saying it does have a daunting task ahead of itself as a sector in 2023, right? What outperformed in the previous year typically does underperform in the ensuing year. What typically has underperformed will outperform in the ensuing years. That's the usual setup. We'll see if that actually comes to fruition in 2023. With that being said, again, welcome everybody to Finom Group's inaugural State of the Market for 2023. Hopefully, this is a much better year than 2022. How we start the year may give us a good indication, if not a reasonable indication, of what we can anticipate as the year progresses. So here's to you in 2023, wishing everybody a successful investing and trading year. A nice quote here that we'll kick off our State of the Market with comes from Mark Minervini. When you believe in a future that is so alive in your mind that you keep living it over and over, your mind front runs your current environment and pulls you into that direction, that new direction. Greatness always starts this way, by thinking greater than your present reality, right? I mean, our present reality is one of uncertainty, I would suspect, given that the markets are closed. We're about to start a new calendar year on Tuesday, and investors have been of the understanding we're in a downtrend. Indeed, that is a reality. We are in a long-term downtrend here that has persisted since the second trading day of 2022. The entire trend changed as the calendar year turned over from 2021 to 2022. Don't be surprised if that happens this year. I got some data to support that, kind of foreshadowing things to come here. Keep you interested. This is going to be a long State of the Market, folks. But I do like this quote. Yeah, think positive. Got to think positive. We want to progress in life. We want to progress as investors. We want to progress as traders. We have to think positive. What do they say? There's a saying, it's a title of one of the all-time classic movies. If you build it, they will come, right? If you create this foundational belief in your mind, you can make it a reality. So think positive. The decline of long-term investing. I found this on Twitter the other day. I forget who had posted it, but in the past, This is the 1960s. Long-term investing, average 8 years, 1970s, 1980s, 1990s. What you can see is every single decade, the understanding of long-term investing seems to get curtailed more and more each decade. As we've entered the 2020s, this is the average, long-term investing time horizon, 6 months. So if you do have a long enough time horizon, your job as an investor, this is something that I had discussed in our trading room last week. If you have a long enough time horizon, your job as an investor is to find reasons to buy equities or equity ETFs, not to find reasons to avoid buying. Often, that is the difference between a charter market technician, a certified market technician, and a certified financial analyst. Market technicians, often they're hunting for problems in the market, right? Technical problems. Financial analysts, they're often justifying valuations for a stock or the market, right? Reasons to buy. So that's why I say oftentimes the difference between a CMT and a CFA is one is trying to find problems, the other one is trying to validate valuations so that you can keep buying, keep leveraging into the market or into a successful company stock. Something else that I had recently posted to Twitter, a lot of investor colloquialisms, they've completely missed the mark, right? You've heard it so many times. Don't try to pick the bottom. Is that actionable? Really, what do you do with that? Don't try to pick the bottom. All right, good, fine, great. But the practical version of this colloquialism should improve to try to layer into bottoms. Why is that an improvement on don't try to pick the bottom? The improved colloquialism enforces a greater discipline known as cash management. And that's what 2022 was all about. That's why we had our roadmap, and we want to be very disciplined, right? Last year, you might recall, in July, we issued a roadmap whereby we would allocate upwards of 10% of cash holdings into the market in 3 different 3.3% tranches, I should say. One would be if the market retested its lows, 3660s, and it, at that time that we created it, it was still at the lows. So our next level was in the 3500s, which we allocated, and below 3,500, which, we got executed when the S&P 500 dropped below 3,500 to its low of the year, 3,491 on October 13th before a massive reversal. We still have one more tranche that we can put on. But either way, 2022 was about having a game plan and managing cash wisely. Nobody should ever try to pick a bottom, but again, there's nothing you can do with that. An improvement to that colloquialism is try to layer into bottoms. And the only real way that you can do that is to manage cash wisely year in and year out, rebalancing your portfolio, having price target objectives for both the upside and downside. Right? It's not working out, for this particular company, this particular stock based on your time horizon. Stick to it, get out. Get the cash back, reallocate someplace else. But these are all disciplines that needed to be adhered to in 2022. If you manage cash wisely in 2022, you got to be of the opinion that a bulk of the bear market is over with. I'm not saying the bear market is over, but the bulk of it is probably over with. And more importantly, you still have cash on hand if it's not. And if we do have even more consolidation and make a new low in the first quarter or first half of the year. Cash management last year. Try to layer into bottoms, dollar cost average. Coming into this year, here's the price targets, right? These are all your Wall Street strategists, if you will. From Fundstrat, which is at the top, 47.50. That's their 2023 price target. all the way down to BNP Paribas, which believes that we're going to finish the year at 3,400. I think the average price target is pretty much 4,000. Some notes here on Fundstrat, how they get to this 4,750. So check them out at your leisure. And don't beat yourself up if you had a poor performance in 2022. Fact is, most investors did, right? To the extent that, oh, I was in energy, right? People, you'll hear that a lot. I was in energy. Were you all in energy? Probably not. Probably not. So a goodly portion of most investor portfolios likely underperformed to the extent that it overwhelmed the gains in their energy portfolio. Here, active mutual fund managers tend to perform worse than the market. As I said, don't feel bad. The average trader can do just as good, if not better, than a professional fund manager. Typically, 15 years, the amount, if you over 3, 5, 10, 15-year period, the number of mutual fund managers that outperform only about 10%. That means 90% of mutual fund managers will underperform the market. 90%, year in, year out. And how come that is? How come more fund managers are outperforming this year, right? 44% are outperforming this year because they're never really allocated. They don't allocate. They're always underexposed to the market. It's more about the fees. And if I keep, the drawdowns low in the portfolio, in the fund, and just, manage to, squeeze out a 3, 4, 5% return annually, I'm doing better than my client's savings account. And if they don't see big drawdowns, they feel more comfortable. They leave the money in the fund. 3, 4, 5% does not beat the S&P 500, which has generated about a 9% return annually going back to the 1920s. And yeah, we have years where it's up 20%, 30%. 2019, we were up 31% in the S&P 500. But again, don't beat yourself up if you didn't do well last year. Most people didn't, professionals, retail traders alike. I know a lot of folks were paying attention late this year. David Tepper, he did an interview with CNBC, which he doesn't do very often. And in the interview, he said he's more prone to be, he would be, he didn't say he was, he would be more prone to be short the S&P 500, until further notice, basically, right? I mean, everybody's looking down. The market has been down. Everybody's eyes are pointed down. The sentiment sentiment follows price. If price was up, people would have better sentiment. David Tepper probably would have said something else. Now, if you look at this tweet here, look at the date, May 31st, 2020. Right, we had already bottomed in March of 2020, right? We had a nice 10+% rally through April, and we kept rallying through May. Did anybody believe? Nope. Here was Tepper back then. Tepper says, too rich for my blood. Market was too rich for his blood. Buffett wasn't buying. CNBC. David Kostin of Goldman Sachs, the market will consolidate. Marko Kolanovic says could consolidate. Mike Wilson of Morgan Stanley says could consolidate. Stanley Druckenmiller says worst value ever for the S&P 500. So, David Tepper saying what he's saying now, he had, poor sentiment toward a market that was in rally mode in May of 2020. People say stuff. Okay, people say stuff. David Tepper doesn't know what's going to happen tomorrow, next week, next month, next quarter, or by the end of this year. That's the beauty of markets. None of us know what's going to happen next. We have probabilities. We do our due diligence. but nobody knows for certain what's going to happen next. It's the beauty of markets. We're all on the same footing. We're all on equal ground. I wouldn't elevate anybody, anybody's opinion over the next person. Nobody knows. So do keep that in mind. Talking about nobody knows and people just saying stuff, right? Brian Shin, and don't get me wrong, I like Brian, I like Willie. They do good work. They have good, tweets, if you will, good information that you can find freely on Twitter. Here was Brian and Willie just this, last week. You know what changes in the market on the first day of 2023? Just the date. That's all. Trends don't change based on a date. Willie Delwich of All Star Charts, everything doesn't reset just because the calendar rolls over. The trends that are intact as one year ends are the ones that will be intact as the next year begins. All of a sudden, these well-known individuals on social media, they're both CMTs, right? They're both professional market technicians, have all of a sudden forgotten the January effect. Like, it's a real thing. It's in the Stock Traders Almanac. It's been studied. History has proven its impact. So when these folks say nothing changes just because of you drop a 2 and you add a 3 here to the end of the calendar year, no, it's just patently wrong. It's very wrong. The January effect understanding tells us this is very wrong. I wanted to dig deeper, though, so I did. Here's what I found. When the new year changed the trend, that's the title here. When the new year did change the trend, 1953, 1954, 58, 60, 62, 67. I can go on and on and on and on here, folks, all the way up to 2015. These years were all years whereby within the first 2 weeks of January, the trend completely changed. 2013, largely sideways. In 2012, we largely went sideways. It did have a 10% gain to finish out the year, but for the bulk of the year, it went sideways. And for some reason, people forget 2013 marked the new all-time high for the S&P 500. It was a breakout year, and it broke out to start the year in the first 2 weeks of January. So this is just wrong. People just saying stuff. Why do they say? I don't know. I'm not, don't ask me to get into people's heads. But it's wrong. 256 people liked it. Doesn't make it right. 48 people liked it. Doesn't make it right. Hundreds of thousands of followers. Tens of thousands of followers. Doesn't make it right. This is your reality right here, folks. First 2 weeks of January, trend completely changed. That's 17 years. So double check. Always double check with these guys. S&P 500, the number of 3% down months by calendar year. Boy, do we have a bunch, right? December of this year, December marks the 7th month of the year with a negative 3% return or greater decline in the S&P 500. So 7 months this year, the monthly return was negative 3% or greater. Almost a record. Or I guess it was a record, yeah, because this will climb to 7. So it sets or ties a record, 1931 and 1937. The average returns the next calendar year, since just World War II, if we use 1957, 1974, and 2008, right? Where you've had these kind of six negative 3% return months or greater, the average return, 30%. That's just the average return, folks. So that's why I say a lot of the bear market, decline, I think the bulk of it is out of the way. I think if we do get any poor January performance, I think you want to take advantage of it with the cash that you managed, maintained, sustained through the end of 2022. I think you got to put that to work if we do see weakness here early in the year. 30% return, folks. All right, S&P 500, past growth scares and bear markets. So this is looking at the past 7 bear markets. So just the bear markets going back to 1987. Looking at the last 7 bear markets since the 1987 crash, we have seen the market bounce back an average of 43.6% over 12 months. So that's from the bottom and over a 12-month period of time. Last 7 bear markets. Yeah, the market starts dropping here again as we start a new calendar year. If it doesn't have a complete change in trend, I think you need to be buying. We'll see. Market opens for business Tuesday. No, almost, right? Almost had a negative return from the pre-midterm election date to the end of the year, which is rare. And that's what this study shows us. And it goes all the way back to 1930. Year to date through election eve, and then election eve through year end. Only 5 previous times did we have a negative return from election eve to year end. And at one point within the last 3 trading days of the year, we were down. We were down. But we managed to finish just 11 points above where we were on election eve. 11 points higher to end the year. Hey, positive is positive. That's why we do these studies. If you had bought election eve, you made money. If you just bought an S&P 500 call or a SPY call, you would have been positive by the end of the year. You had a positive return. And that's why we do these. There's little trades like that that you can do throughout the year by knowing your data. Knowing your data. All right. Is a bad December a bad sign? Right? Because we were down more than 3% in the month of December. Is that a bad sign? Doesn't really look like it. Here's since 1957, the worst Decembers, right? Because December is usually positive. So the sample size is very small here, right? 4 times previously, this one makes the 5th. Going forward, 1 month, 50-50, right? Percent of the time higher, 50-50. 3 months later, still 50-50. 6 months later, 12 months later, percent positive rate gets very, very good at 75% positivity rate 6 and 12 months later. So maybe some weakness in the first quarter of the year, maybe. But history says take advantage because 6 months and 12 months later, good things are more than likely happening in the market. The toy barometer, right? We're in that toy barometer period, and I wish I had good things to share, right? Toy barometer started this particular calendar year on the 21st of November, and it'll finish on January 19th of this year. In fact, let's make sure, see where January falls. Yep, Thursday, January 19th. Right now, we're down a little more than 4% over the existing toy period. Historically, the relevance here is that if you gain more than 3% during the toy barometer period, toy stands for turn of year. If you gain more than 3%, that's it means it fired bullishly. And of the 36 times that it's fired bullishly, going all the way back to 1950, only twice was the market negative, 1987 and 2018. Only twice. It's a 90+% positivity rate for forward returns over the next 12-month period. 34 and 2. 36 times it fired bullish, 34 times the market had a positive forward return over the next 12 months. But again, right now we're down a little more than 4%. We got to get to a 3% plus gain to fire a bullish toy signal. right? That's 7+% that we need to gain in, up to the 19th of January, right? Less than a month. Is that probable? It's unlikely, right? 7+%. It's unlikely. Now, it may be neutral, right? Maybe we recapture the 4% loss and just have a 1% gain over the tort period. That's a neutral signal. And we'll get into that, during our next state of the market. But right now we have a bearish toy barometer. Right now we have a bearish toy barometer. So we'll see how things progress once we hit the ground running, the first day of January trading. This is one I want to refamiliarize ourselves with, right? Because we talked about the 2 in 10 breadth thrust from Steve Depp in the past, but we kind of have to revisit the past as we start a new year, just to refresh, know where we were, so we can have an idea of where we might be heading. We had back-to-back months where we gained more than 10% over the 2-month period. Historically, that's telling you something's changing in the market. There's a character change going on in the market. All right, it fired on November 22nd. Okay, and the S&P 500 was at 4079. All right, we gained more than 10% over a 2-month period. Closed at 4079 on November 22nd. Here, the 1-month returns are usually positive. 72% of the time positive. Were we positive on December 20th, as of December 22nd? No. So cross that out. 2 months later, 90%, folks, almost 91% of the time, the market has been positive. Look at that. There we go, blow that up, right? Only once red, November of 2002 was the signal there. Going forward, 3 months, only twice was the market. Here's the good news. Let's get to the good news, right? 6 months later, 8 months later, 12 months later, market has never been down after a 2-month 10% gain. 6 months, 8 months, 12 months later. So where does that put us, right? Where do we need to be? That's what we better know. So 6 months later, which would take us to the end of May, right? Or May 22nd. No, I'm sorry. April 22nd. 6 months later, April 22nd from November 22nd, right? That's 6 months. We need to be 4079 or better to keep this 100% positivity rate. That's why I say this data is good to know so that you can do your calculations and know, okay, maybe the market falls in the first part of the year, but historically it has never been lower after the 2 in 10, 6 months later. So maybe it falls, and then by April, we're back to 4080. Right now, we're at 3839 in the S&P 500. If this holds true, you should be buying come tomorrow, regardless. You should be buying, because historically, we should be back above that level. We'll see. We'll see what happens here. Midterm seasonality also, right? November through April, midterm year through April has never been negative. Has never been negative. Where did we start the midterm? That was on the 8th. I should have included it, but let's go to it. Midterm this year was on the 8th of November. 4, 7, 8. There we are. 8th. So 38.28 was the close. 38.28. We should have a positive return come April, because the market has never been down in the November through April period. Has never been down. There's no negative signs here, folks. The worst return, 0.7% in 1946. Yeah, everything else is nearly 5%. 4.4, 4.5. Everything else is nearly 5%. The average is 17.2%. This is compelling, folks. This is very compelling. We need the macro to cooperate, right? We need the macro data to obviously cooperate. And we'll see what that looks like, right? Because the first week of a new calendar month that has a Friday is jobs week. So we're going to get jobs data right out of the gate here in 2023. We talked about this study quite a bit. So let's update ourselves, see where we are. 20% plus 2-quarter drop, which is what we had at the end of June 2022. The next quarter has only been down once until this year, because the September or Q3 was down. We finished at 37.85 at the end of June. We finished at 35.85 at the end of September. 2 quarters later, or a half a year later, the market has never been lower. And lo and behold, we haven't, right? So from 35.85, a half year later, right, we finished at 38.28. I'm sorry, 38.39. So this is still 100%. 100%, folks. A year later, market has never been down either. So a year after the 2-quarter drop, that'll take us to the end of June 2023. The end of June 2023, the market should be better than 37.85. So think about it. We're 50 points from that right now. So if the market does retreat, gets below 37.85, it's another buying opportunity based on history, because the market has never been lower a year later after 2 quarters of a 20+% drop. 37.85 at the end of June. A year later, we should be higher than that. So that's the end of June this year. We're in the sweet spot. That's a lot of this data shows you the sweet spot. And the sweet spot is basically Q4 of a midterm year through the first 2 quarters of a pre-election year. The pre-election year is known as year 3 of a 4-year presidential cycle. This is a sweet spot. Look at how high these bars. These are returns. These are S&P 500 return bars. They're the highest of any other cycle. This is the sweet spot we are in right now, folks. What about double, down years, right? Could we have the first back-to-back negative return years since basically 2000 to 2002, which was 3 down years in a row? They're very rare, right? We just have, since 1929, 4 examples. They're extremely rare. What's notable, this is why knowing your cycles, presidential election cycles, midterms, so on and so forth, none of these happened in a year 3 of a 4-year presidential cycle. None of them. And that's what we're in right now, 2023. So again, no matter, go all the way back to 1929. None of the back-to-back down years happened that included, the presidential year 3. So it's rare. It's not impossible. Obviously, this could be a first. But our job is to lean into the probabilities as investors. Otherwise, what is this data good for? You lean into the probabilities. All right, moving on. We talked about this one. And it seems as if, every time we get that the percent of stocks above their 50-day moving average hitting 90% or better, the market starts consolidating. Nonetheless, here we are. We did it twice this year. We did it twice. Now, the first time we did it was in August. 42.80 was the price of the S&P 500 on that signal date. And I bring that up because 12 months later, the market has never been lower. It's always delivered a positive return 12 months later. So August, we're not talking about June, right? The end of June now. We're not talking about the end of June now. We're talking about August. By August, we should be, again, above 42.80 if this breadth thrust study holds. And again, this is the percent of S&P 500 stocks above their 50-day moving average hitting 90% or better. Signal date from August 12th, the S&P 500 was at 4280. So by August, we should be higher than 4280. And so for some of these folks with these price targets, if you will, right? 4,300, 43, 44. There's only 1, 2, 3, 4, 5 folks with a price target higher than that. We'll see what happens, right? We'll see what happens. S&P 500 closes above the 200-day moving average, right? That happened on November 30th. It happened. And the S&P was at 4080 when it happened. 1 month later, historically, when you spent 143 days or greater below the 200-day moving average, then closed above the 200-day moving average, 1 month later, usually the market's higher. Not this time. Not 2022. 3 months later, still 75% success rate or positivity rate. 6 months later, 12 months later. The only time it was negative, it looks like 2002, 6 and 12 months later. That's it. It's the only time. People always compare. They're comparing this year with 2008. But the reality is the S&P 500 didn't get back above its 200-day moving average in 2008. It didn't do that until 2009. Do keep that in mind when you see all those nefarious charts out there comparing or using it as an analog for 2022. Only once. So 6 months, November 30th, right? We should be above April. That's April again we're talking about. We should be above 4080 if this study is going to bear the highest probability. We had a bullish outside reversal on October 13th after a positive surprise for the CPI, right? That big reversal. We dropped to 3491 at the markets open that day and finished higher by nearly 2.5% or so, 3%. Historically, when you have those kinds of bullish outside reversals, it's usually the bottom. Usually that's the bottom of the market. In fact, it was almost every single time. Here's the dates that it's happened going back to 1981. I went back to 1975. In looking at the dates above and recognizing that only 2008 signal found the S&P 500 down 3 months later, right? Only 2008. I went back to 1975 to recognize that never had an outside bullish reversal day from a 52-week low found the S&P 500 down 6 and 12 months later, except for 2008. On October 13th, the S&P 500 finished at 3669 on October 13th, the day of that bullish outside reversal. So 6 months later, right, that'll take us to, I guess it would be October 13th. So count out 6 months. That'll take us to March 13th. We should maintain above 3669. Let's see if it comes to pass, just like anything else. You've seen this chart before. Again, it's the worst year for a 60-40 portfolio since, I guess that was 73, 74. Before that, 1930s. Worst year for the 60-40 portfolio. Here's the good news, because what you can't tell, I mean, the next 2 years were good. Next 2 years were really good. Here's the returns for each of those, right? So there's 1930, the 60-40 portfolio. That was the only time. The next year, down 31%. So that was the back-to-back down years. And back-to-back down for the 60-40 portfolio. But after that, 5% positive return. And every one of these, except for that back-to-back down year here, was positive. The average and median returns are noted. So I keep saying the worst of the bull market is probably behind us if history proves a guide. Pre-election year, right? Year 3, pre-election year. How does January perform? In a pre-election, just January, not the year, but just January since 1950. In the pre-election year, 16 times has the S&P 500 been positive. Only twice was it down. NASDAQ, because that NASDAQ didn't genesis until 1971. But same thing, only down 2 times. Only down 2 times. History is on the side of bulls right now. If we're just using the quantitative and seasonal cyclical data, history is on the side of bulls. We'll see how it plays out. A lot of you who've been with Finom Group have seen this study before, right? The January barometer hasn't been as accurate lately, right? Because most of the time when the January month is down, the final 11 months of the year, most of the time have been positive, except for 2008. And if we add to 2022, right? Because we had a negative January in 2022. But what most people miss in this is a pattern. A pattern developed in 2008. Look, 2008, 2009, 2010. Down, down, down. 3 years in a row. Where's 11, 12, and 13? Well, they're not on here because they were positive. 3 years in a row. 11, 12, and 13. Then 14, 15, 16, down again. 3 years in a row. So 3 down, 3 up, 3 down, 17, 18, 19, we're all up. 3 years up. And then 20, 21, and 2022. 3 years down again. Literally, that has been the trend. 3 years down, 3 years up, 3 years down, 3 years up, and now we just went through 3 years down for the month of January. That means we should be 3 years up in the month of January going forward. Starting 2023. Again, no matter how we look at the data, it's all suggesting that the bulls are going to find favor. All right, few macro notes here to keep apprised of, right? We studied the Philly state coincident index. We're following that because, look, the more states that you have that are experiencing a GDP contraction, the more likely we're going to have a national recession, right? As of right now, we've got, I think it was 16 states that are either in contraction, GDP is contracting, or unchanged, which is the highest. We ended the year with the highest number of states in contraction. But historically, these are the dates that we've seen the number of states were in contraction or recession, if you will, before the actual national recession happened. In 1980s recession, we had 30 states that were already in contraction. 1981, 30, 1990, 26, 2001, 24. 2008 was kind of an anomaly because everything just went to like that. March 2020, obviously shut down the entire country. So the average is 26 states. Right now we have 13 that are actually in contraction, and then 3 others that are basically unchanged. They're not growing, they're not contracting. So we're not even at the average yet, so far as having a national recession. Here's another recession indicator, if you will. You take the leading economic indicators divided by the coincident economic indicators. And indeed, right now it looks like we should be on the cusp of a recession. Here's the lead times before the recessions. 2 months, 9 months, 7 months, 2 months for all these recessions since 1969. Where this ratio is falling. We currently have an 8-month decline in the ratio. 8 months. which, is the second highest. 9 months had, consecutive decline in the ratio back in 73. Right now we're at 8 months. It does, beg of recognizing a high probability that we could find some degree of a recession, at some point in 2023. If we don't, it'll definitely be an anomaly, that we will have to go back and find a new appreciation for the health of the household and corporate balance sheet that has enabled, despite manufacturing being in a slump, if not a recession, despite housing being in a recession, the economy is able to grow. And who knows, maybe we'll even be able to squeak out some earnings growth in 2023 by the end of the year. We don't know. We don't know for sure. One thing I do know is, again, while, this points to a recession, this says no chance. This is motor vehicle retail sales for heavy duty trucks, which were growing 16.6% the end of last year. 16.6%. We've never had a recession when you've seen heavy duty truck sales rise by double digits. Never happened. But we have a lot of counter, data that is just countering each other. It's very interesting times. Secondly, real personal income less transfer payments is still rising. This is not what you see when you're in a recession or on the cusp of a recession. So we have a lot of conflicting data, folks. It is what it is. Morgan Stanley, so far as earnings that I had mentioned earlier, they think earnings can trough the $195 a share this year, which would be a little bit more than a 10% decline in EPS. That's not ideal, if we're looking for the S&P 500 to have positive returns in 2023. At the same time, none of this is set in stone. They are kind of the low on the street when it comes to their forecast for earnings for the year. So we shall see. All right, folks. I hope you enjoyed our inaugural 2023 State of the Market. Stay nimble, stay positive in 2023. Manage cash wisely until we see something break the downtrend that would, suggest you can get more aggressive with that cash that you sustained. You did a lot of good work in 2022. Stay disciplined here in 2023. Stay invested. Look for opportunities where you can buy cheap. Buy low, sell high. Don't make it much more complicated than that. I'm Seth Golden. See you next time on our State of the Market.